Hey everybody, it's Chris with Life 180, and this video I wanted to talk about utilizing a whole life insurance policy as a banking alternative. So I just had a case study kind of come across my desk. A guy suggested that I take a sample of an individual who's in his late 20s who has $30,000 sitting in a bank and can afford about $10,000 a month, right? So let's the amount of the premium kind of going forward and the amount of like what I would call as a forced savings plan going forward, that can be manipulated a little bit. But at the end of the day, the reason I love this so much is because, remember, I always talk about whole life insurance not as an investment, but as an alternative to a banking strategy, right? Like you want to make sure that you don't compare it to an investment because the moving parts inside of a whole life policy are completely different. It's got guarantees, it's got liquidity, it's got access. It really... That's why we talk about it as the and asset. You can have your money in this policy, access it like you would a bank. And when you see if you set it up and you structure it properly, anybody that's got a lot of money sitting in a bank account, this can be scaled up, down, all around, whatever, as long as there's a relative ratio between the amount of money you have in the bank and the amount of money that you can save annually. As long as there's not too much of a divide there, say like a 10x divide, for instance. You got 100K in a bank account. As long as you can save $10,000 to $15,000 a year, you can make that work, right? So there's all these different things that you can kind of work into here. But what I want to do is I actually want to go here and I want to show my screen, and I am working on this here. So this is a policy that was put together. I had an illustration run, and ultimately here's the deal. It shows that you can see here the guy's 28 years old. At 29, a year into the policy, he's got $30,000 going into this the first year, and then a $10,000 annual premium, pretty much going on thereafter. And to avoid the modified endowment contract limit, year 16, the premium drops down from $10,000 to $9,519. But here's the bottom line. Let's take a look at this. And when we talk about it being a banking alternative, here's why. Because when you look at year one, you can see at 29 years old, he's put $30,000 into it. But when you look at the net cash value, that's the liquidity and the policy that he has based on the dividend scale this year for that company. So he's going to have $25,481 liquid. So what does that look like? Now, yes, he had $30,000 in his bank account, and he's transferring that into this account, and he's giving up some liquidity for that transfer, right? Because it's instead of 30, he's got 25.4, so he's losing $4,600 of liquidity. Let's talk about what you're getting for that. Well, first of all, you're investing yourself into a system, right? Into a strategy, into a process, into something that's going to give you long-lasting, long-term benefits. If you've ever watched my Life 180 Pyramid Talk, you know I'm a big believer you need at least 2 years of income, liquid, safe, controlled in case of emergency and or opportunity, right? So this is where that starts. This is the foundation of your financial pyramid. And so when you look at that, the $25,000 there, picks up $1.336 million in death benefit, right? That's a huge thing. Now, this is why I say this is important, because not only are you saving money in this situation, by moving the money and giving up a little liquidity on the short term, now you've picked up a self-completing program, savings vehicle. Because I don't know about you, but I'm married, I have 3 kids, and I'm saving money, right? I save money for my family. I save money for my future. I save money for opportunities and emergencies. But I want to make sure it's self-completing, because God forbid something happened to me and I die in a car accident. I die in a plane crash because I travel a lot. I have, something, I get hit in the head by a golf ball. I live on a golf course. God only knows what's going to happen, right? If I die, my plan, why I'm saving, why I'm putting my money away, is not just for me, it's for retirement, but it's to make sure that our standard of living is complete. But if I go away, if I die, I want to make sure that that plan self-completes, because if I'm saving money in my bank account and I die, what do I leave? I leave 30 grand, right? Is that going to make an impact on my wife and my kids' life? Probably not, right? Like, I definitely know not in my situation. And so by putting this 30 grand away, I have a $1.336 million death benefit. That's going to make an impact. That's going to make a difference. I know for me, I want to make sure that if something happens, I don't want my wife to have to remarry for the sake of financial security, right? I want to make sure that I do my part to take care of my wife and kids and make sure that what I want to happen will happen when I want it to happen, whether I'm here to see it or not. And that's the idea of real planning, in my opinion. And so when you look at this, The $25,000, $25,481 year one. So we gave up $4,600 of liquidity. Okay, that's fine. So now let's go to year two. You put 10,000 in, so that's a forced savings of 10,000. So let's just take that $4,600 from the year before and just imagine it's gone. That's the cost of doing business. That's a cost. That's your investment into the plan, into the strategy for your future. So you can see the next year you put 10,000 in, you have $34,481 left. So now your value literally went up by $9,000, right? So you're literally, you have liquidity of most of your money still, right? Like you're still investing a little bit of money into that, right? But 90% of what you put in that year is liquid, controllable, right? So your access is going up. And you can see year after year, by the time you hit year four, if you look at this little spread right there, year three, you have 43,991. So out of the 10,000 you put in, about 9,500 is liquid. But then year four is the magic number where you start putting money in, the 10,000 in, but the net value increase you can see here is $10,011. And then the next year you're putting in 10,000 and you got 10,552, and it just keeps growing from there. And so when you look at this and you look at and you compare it to a bank, let's look at the the 6-year, 7-year period here. You're looking at, you're putting 87 in, and or you've put what, 30, 40, 50, 60, 70, 80, 90, but you really haven't given up much liquidity in this scenario. You've only given up $3,000 of liquidity, not even $3,000 of liquidity over that period, but you've picked up over $1.5 million of death benefit. You haven't given up any control of the money. But here's the best part. When you look at leveraging this money, you have access, liquidity, use, and control of this money. You can leverage this to invest it in real estate, to invest it in crypto, to invest it in a business. If you have kids going to school, if you have any capacity, if you want to finance your own cars, if you want whatever it is, any major capital purchase in your life that you want to flow through this, you can do it and leverage it with a loan against your contract. And then you can use that money to take care of whatever you want of those things that I just mentioned. And then you're paying. A lot of people get this wrong. They're like, why would I want to pay interest to access my own money? Well, the bottom line is you're not paying interest to access your own money. You're paying interest to get a loan from the insurance company. And what the insurance company does is they guarantee you access to money by collateralizing the cash in your policy. So the power there is that when you do it that way, first of all, the tax benefits, you don't have to pay taxes on loans, on loan money, right? Like that's the beautiful thing. And then secondly, you're never interrupting the growth of your policy. So if I take a loan in this situation at $87,000, let's say I take an $80,000 loan right there, I don't have to worry about that $80,000 getting interrupted. If I have a 5.25% dividend here, it's still going to grow at that rate, right? Like that's pretty awesome, right? All the while it's growing at a compound rate, but that $80,000 that I take, let's say I pay a 5% interest rate on that loan, it's simple interest. So even if all I do is make an interest-only payment on that, I'm getting ahead because my money is growing on a compounded basis and I'm paying simple interest back to the insurance company. And it's unstructured. So the beautiful thing is if you're a business owner, if you have income that's kind of all over the map and it's inconsistent, and you say, okay, I need access to this money for something, whether it's an investment or whatever, but I need it to be unstructured because I know I may have a couple months that are tough. Then I have a season where it's really busy and I have a lot of cash flow and I can pay more during those months. I don't want this to impact my credit. Your credit has no basis or bearing on your ability to get a loan leveraging this tool. And so those are just some things to consider when you do this. Now, once again, I don't need to beat this horse dead. Like it just comes down to the fact that I wanted to show this because it's really, really important that people don't look at this as an investment. We call this an and asset because it's not an either or conversation. That's one thing that I'm super passionate about. I love business and I love real estate personally. I know not everybody's into that, but I'm just going to use that as an example here because if you look at real estate as an example and you said, I really want to buy a property, right? Your need for capital to buy a real estate property is not going to change one way or the other, whether you save it in a savings account or whether you save it in a whole life policy, right? Putting money into investments is just taking on risk, and it's a different investment class of its own. To me, you put money into a whole life policy, it guarantees the growth of the funds. It's predictable. You have liquidity, use, and control of it. And so if you want to buy a house and you want to save cash and then pay cash for the house, it's the most effective way to do it. If you want to save your down payment here, you basically create a second mortgage for yourself to be able to get your house, right? Like that's your investment property or whatever it is. Even a primary home, this would be a great way to go about doing it. And so you can see here that, if you need a 20% down payment, by year 6, you could have it predictable, and you could have the money there predictably. And the reality is, this will just scale. Your needs are going to be based on what your desires are. So we always talk about creating a plan that is not focused on rate of return, but return on result. What is the result that you're going after? And is what you're doing right now going to get you closer to the result on a predictable and guaranteed basis? And that's one of the most important things to talk about. So when you look at a whole life policy, you can see there's no other asset in the world that's going to give you liquidity, use, and control of your money. And the way that this is, it's very similar to a bank account. But if you look at bank accounts, you go broke slowly by storing your money in there because they give you 0.1%, maybe 0.2%, and you slowly go broke because of inflation. Because let's face it, every year the cost of living goes up, money gets devalued, the Federal Reserve is printing trillions of dollars. God only knows what's going to happen to that. And we call this the and asset because this is just a storage vehicle for your money. You take the money, you access the money to put into investments when you deem appropriate. If stocks are your thing and you're really good at picking them and you're Warren Buffett Jr., go nuts. If real estate's your thing, awesome, give me a call. We can help you out there too. If business is your thing, there's not much of a better way to have business capital reserves than a whole life policy. It's a fact. I mean, there's a reason corporate-owned life insurance and bank-owned life insurance is being done the way that it is. There's this amazing book right here, Pirates of Manhattan. Just as a side note, it's a phenomenal book, and it talks about the fact that these banks do this. So why wouldn't you? Tier 1 capital for assets for banks. Permanent life insurance, whole life insurance is considered tier 1 capital for banks to be able to have on their reserve balance sheet. So think about that. That's secure enough capital that banks leverage to be able to lend out more money to be able to earn more money. You hear what I'm saying? I'm trying to get you to do this same strategy in your life, in your personal life, operate like the banks work. That's why a lot of people call it the infinite banking strategy, right? So if you look at this, think about it. If this wasn't a good idea, why would Wachovia have 39% of their tier 1 capital tied up in bank-owned life insurance? 39%. That's including all their customer deposits and everything. 39% is in life insurance, right? That's just TD Bank North, 36%, 32%, I'm sorry. PNC Bank, 26%. Sovereign Bank, 34%. Bank of New York, 31%. It goes on and on and on. There's these banks leverage bank-owned life insurance, which is exactly how I would structure or suggest that you set it up in your life to do it. They do it through different channels, but it's essentially the same thing. The strategy, the concept, the principle doesn't change. So listen, I find it fascinating that banks like this make most of their money selling investments and products and services of that nature. But when they make that money, they take it and they put a lot of it into these assets. Yet it's like the biggest con, I think, in my entire life that I've ever seen. And so what I would suggest to you is take a look at this policy, really look at the numbers. I'm leaving the numbers up here as I'm talking, and I'm talking up in the top corner on purpose because I want you to be looking at these numbers and really thinking about how this could be leveraged in your life. And if you stop thinking about this as an investment and you started thinking about how can I implement this in my life as a banking alternative to save and have a forced savings plan that's going to help me get closer and closer and closer to my desired results in my life that I'm looking for on a predictable and guaranteed basis. There's not another plan in the world that will do that. And it's self-completing, just to say this one more time, that if you're married and you have kids, you want to make sure that what you want to happen will happen when you want it to happen, whether you're here to see it or not. I think that's an important thing to understand. So I hope that helps. If you like this video, go ahead and smash that like button. YouTube loves that. If you haven't already, hit the subscribe button, click the bell. That way you get notified every single time I launch a video. And I hope you found this video valuable. If you have any comments, leave them below. I will engage with every single one. Until next video, have a blessed, inspirational day, and we'll talk to you soon. See ya.